Hello guys, and welcome back to another video. In this video I'll be going over the four terms of market structure shift, displacement and fair value gaps. Okay, so first off I'm going to explain each term one by one, and then I'm going to show them in chart examples. Okay, so first off, what does market structure mean? Well, simply all market structure means is how highs and lows are presented in price action. So if we look at this chart of NQ on the daily chart, we can see if we draw from this high to this low, we made a lower low. From this low to this high, we made a higher high. From this high to this low, we made a lower low. From this low to this high, we made a higher high. And you guys get the idea. So as you can see, we're making a higher low, and we are breaking highs. So this is an example of bullish market structure, meaning an uptrend. Okay, so why is this useful? Well, if we are seeing, so if I go back, if we continue it out, see how again, if we can see that we are now making higher lows and higher highs, this is very important, because if we know now that we are on an uptrend, we can then look to target old highs for buy side liquidity, and also be on the right side of the market so that we don't take losses by trying to go short and have unrealistic expectations of us potentially being aiming for some unrealistic targets that are more in below the market. Okay guys, now I'm going to go over market structure shift. So all a market structure shift refers to is a change in trend, right? So as I showed previously, we were clearly in a bullish market structure, and then right here we make a low here, a swing low, but then as you guys can see, we then make this high here, failing to take out this previous high, and then we break lower here. And that's our market structure shift, because we changed a trend, we failed to make a higher low, and this is what our market structure shift would be. Okay, so that simply refers to market structure shift. So I'll label that for you here. There you go, that's your market structure shift. Thirdly, displacement simply refers to an energetic price move either to the downside or the upside. So what an example of displacement would look like would be something like that. This right here. Can you see how energetic that was to the downside? We broke lows. See that? All these lows here were broken, and we also left behind a gap with large range candles showing that this was very energetic. This would not be displacement, this down movement here. See how lethargic and slow that is? That is not. This is very fast, energetic. This is displacement. Now guys, before we continue on with the video, I really quickly want to talk about my private mentorship. Now, if you made it this far into the video, you are definitely a serious trader, and I'm sure you really want to look to improve your trading skills. So when you join this mentorship, you will learn the exact model that I have taught to members, helping them all get 6 figures plus in funding and make 10k plus a month from trading consistently and quit their jobs for good. The mentorship will also include weekly trade breakdowns every Sunday at 7 PM GMT, where I'll host a Zoom call for all members, going over all the major forex pairs, indices, commodities. All calls are recorded. All of my trade ideas will be sent to the group live. Every trade that I take will be sent in real time. There's also a Discord community with 24/7 support, a bunch of trading psychology help, and how to be a part of the 10% of traders that win consistently. So now, if this sounds of interest to you, then I highly suggest you click the first link in the description. It's lifetime access for one-time payment only. It's currently on offer. It was previously $249.99. It's now $149.99 for a limited time only. Prices will soon be going back up, so I highly suggest you click the first link right away and join right now and take that first step towards financial independence. Another example of displacement will be right here. We took out this swing low here for sell side liquidity, and then we energetically moved to the upside, breaking this swing high here for our market structure shift, like that. And we also left behind a fair value gap. Okay, This is what displacement looks like. It's very energetic, and we usually leave behind larger-ish candles, which as a result leave behind fair value gaps, which then brings me on to my next point, which is displacement. Sorry, not displacement, fair value gaps. And all a fair value gap is a free candle pattern like this: candle number 1, candle number 2, and candle number 3. And a fair value gap is simply a gap between these 3 candles like this. Okay, so this would be your fair value gap. And with fair value gaps, all it is an inefficient delivery of price. We only delivered price on the downside, and we left behind a gap, meaning that this was inefficiently delivered, and the market will look to come back into this gap to make sure that price is efficiently delivered. Okay, now fair value gaps are important for many reasons, such as entries and targeting purposes. So I'll show you how we would use that. So on this occasion, we did not get filled into this fair value gap right there, but then if you look at a later time here, we didn't use an entry because overall we're in a bullish market structure. Okay, we went down temporarily as a retracement, part of this larger uptrend. Okay, so you need to understand what environment you're in. So not always are you going to have a prolonged downtrend. You might have a market structure shift, but it might just be temporarily, just to have a retracement of the current overall larger bullish uptrend. Okay, so what happens here, if you guys look, there's a fair value gap right there. This candle's high to that candle's low. We enter, and then we look to target highs here. Now also guys, if you notice why this fair value gap entry will be valid, well, it's because if we draw a Fibonacci, a fib from this low to this high, 50% is here, and anything below is a discount, and this fair value gap is below 50%, so this will be a high probability entry. So we enter there, and then we look to target that. And you guys can see, every time we create a fair value gap, see that? This is your fair value gap, 1, 2, 3. We always fill it back, fill it here, continue to the upside. We make another fair value gap here, we fill it there, and we continue to the upside. Okay. Here again, fair value gap, continue to the upside. Again, more examples here. Fair value gap, fill it right there, continue to the upside. Alright, fair value gap. This is something referred to as liquidity void, where between 2 candles there is absolutely nothing, it's just blank space. Okay, but yeah, as you can see, we still fill in this gap, which is another type of inefficiency right there. Okay, but yeah, that's pretty much it guys. I tried to make this as simple as possible to introduce you to these terms, and yeah, hopefully you guys enjoy the video, and I'll see you again next time.